Good afternoon. Please bear with me in the next 20 minutes for a speech about the global economy, the MENA region, and the G20 and Saudi Arabia. Ladies and gentlemen, let me at the beginning thank the Institute of International Finance for inviting me today in the annual spring meeting that is taking place here in Tokyo. Saudi Arabia and the IIF are well linked up with about 12 financial institutions are members in the IIF. And I see some good potential to have more good relationship in the coming days. It pleases me to be able to deliver my address here, not just because of the efforts that the organizers have done in creating a wonderful venue, but also because we are in Tokyo. Indeed, ties between Japan and Saudi Arabia go back far in history. They have been further strengthened in the year 2016, when His Royal Highness Mohammed bin Salman and the Prime Minister of Shinzo Abe concluded strategic partnership by setting up the joint group for the Saudi-Japan Vision 2030. Since the theme of this 2019 spring membership meeting is the G20 agenda under the presidency of Japan, I cannot fail to refer to another link between the two countries, which is beyond the fact that we are both G20 members, that Japan will be handing over the G20 presidency to Saudi Arabia. And I'll come back to this element later on. Let me first, however, make some reflections on the state of the global economy, and then about the MENA region, that's the Middle East and North Africa, and then the economic situation in my home country. On the global picture, I am fully aware of the fact that you already had 2 sessions on this topic yesterday. Moreover, the G20 ministers of finance and central bank governors tomorrow in Fukuoka will have the same, in particular to take some stock of whether the developments since the IMF and the World Bank spring meetings in Washington, D.C. warrant some revision of their appreciation of the economic situation and the outlook. I will therefore seize this occasion to convey 4 general messages to you. First, the global economic expansion has been slowing down since last year, somewhat more than anticipated a few months ago. Nevertheless, the consensus view remains that there continues to be little risk of a recession in the year ahead. In other words, one may describe this as a soft landing situation, barring what is happening nowadays in the trade tension. However, as policymakers, we know that very long economic expansions, like the current one, may be more prone to shocks. That is so because underlying vulnerabilities have had more time to build up. Let me focus on 3 of those vulnerabilities. Number 1, the continued low productivity growth in many countries, which may be a sign of demographic development and corporate underinvestment. But it may also be a reflection of the secular shift from the manufacturing to services where productivity tends to be lower. Number 2, the elevated levels of financial asset prices in some countries more visible in housing market, in others more in equity or bond market prices. And number 3, the rising overall debt that may become more prone to confidence shock. Again, the situation differs across countries, with some having seen a run-up in public sector debt over the last decade, and others witnessing such a development more in the private sector. I should qualify here the private non-financial sector, because the financial sector, as we all know, has definitely been more prudent in its pace of debt accumulation since the global financial crisis. My second message is that geopolitics continues to represent an important downside risk factor to the economic outlook. Let me just note that in several continents, there are geopolitical elements at play that could have ramifications, not just for the regional outlook, but even beyond. What is not so comfortable for policymakers is that financial markets, understandably, find it difficult to price the effects of the geopolitical developments in a forward-looking manner. This leads to more volatility in asset prices, and here I would include commodity markets, among which the oil market. The third general message, the banking system globally is now in a much better shape than it was some 12 years ago to absorb negative shocks. And here comes my qualifier, the banking system is only one part of the global financial system. Non-bank financial institutions have grown in importance. It is not fully clear whether policymakers in all countries will have all the tools at hand and whether they will all have intended effect to put to use and to address the fallout of an economic downturn on the financial sectors as a whole. We therefore need to remain vigilant so that we continue delivering on our financial stability assignment. My last point in the context of the global economy is that the policy room for maneuver to address a weakening economy now seems less readily available than could be expected after such a long economic expansion, especially in comparison with the situation prevailing prior to the GFC. Interest rates remain at historically low levels, and fiscal space is generally more limited. But I can assure you that policymakers will act promptly if needed to shore up economic growth. This was, by the way, the message conveyed in the communiqué of the IMFC less than 2 months ago. It was precisely what some of the major central banks did around the turn of the year and in the spring of this year. Moving from the global picture to the regional one, let me say a few words on the MENA region, that's the Middle East and North Africa. As we all know, it is comprised of a very divergent set of countries. Not only does the region comprise oil importers and oil exporters, it also harbors countries at very different levels of per capita GDP. Still, they have a number of policy challenges in common. I want to mention 3 of them. First, the region needs to have more private sector-led growth, be it to diversify away from their high dependency on oil, or to generate stronger job creation and thereby foster economic and social inclusion. In turn, this implies important policy agenda for structural reforms. Second, the region needs to keep an eye on the public debt ratios. Many of the oil importing countries now have debt ratios that do not only distinctly exceed the levels reached in 2008, but are also in excess of 70%, which is a kind of benchmark ratio for emerging market economies. Evidently, the situation more relaxed for oil exporting countries at the current juncture, but things might change rapidly. Third, there is a need to lift the growth overall in the region. I draw your attention to the fact that the regional growth of the MENA region has trailed the world economic growth rate in 5 out of the last 6 years, even more so on a per capita basis. In addition, this picture is not expected to change for the foreseeable future based on unchanged policies. According to the Spring 2019 World Economic Outlook of the IMF, the MENA region is projected to continue trailing the global figure for annual GDP growth between the years 2019 to 2024. I am convinced that a higher degree of financial development in the economies of the region, along with the more structural changes, will contribute to higher growth. In turn, financial innovation can play an important role in fostering the development of financial markets in emerging economies, as well as promoting financial inclusion. Let me now say a few words on how Saudi Arabia is faring against the background of the global vulnerabilities and regional challenges. Last month, Saudi Arabia had the annual visit of the IMF for its Article 4 consultation. IMF staff found that the economic outcomes in Saudi Arabia have improved in 2018 compared to the year before, and its expectation is for the real non-oil GDP growth to strengthen further this year to close to 3%. These improvements have to be seen against the background of somewhat slower world economic growth. Over the midterm, the IMF projects non-oil growth to perform still somewhat stronger, as the economic reforms which we have been undertaking are expected to yield increasingly positive results. Around 1.5 years after the introduction of the value-added tax in my country, the common assessment of all observers is that it has been a success, also because we protected the less well-off from the immediate negative effects of this important structural reform. Currently, we are registering a negative year-on-year inflation rate, but this is projected to be a temporary phenomenon. Important reforms have been implemented to make Saudi Arabia more business-friendly. Bankruptcy, commercial pledge, and franchise laws have been adopted. FDI licensing requirements have been made more efficient. Several initiatives have been implemented to support the SME development and entrepreneurship. All of this should favorably influence business formation and trade. In the framework of our Vision 2030 and the accompanying vision realization programs, we will further improve the climate for doing business in our country. We aim at developing new and expanding existing sectors of the non-oil economy, attracting foreign investors, and developing small and medium-sized enterprises. We are going to attract the skilled foreign labor with the long-term residency scheme, and we will work to strengthen the human capital to the Saudi workforce in order to boost productivity and competitiveness. Being part of the G20 process, where many of these issues are discussed and notes are compared between countries, provides my country with an additional opportunity to map out the best available venues towards lifting growth and thereby contribute to the G20 common goal of strong, sustainable, balanced, and inclusive growth. As I have said earlier, an adequate degree of financial development of the economy will be of help in attaining stronger and better growth. It is in this domain that SAMA, the Saudi Arabian Monetary Authority, together with the other financial authorities in Saudi Arabia, has a role to play. As the microprudential supervisor of the banking system, SAMA remains fully committed to the regulatory and supervisory reforms that the G20 has agreed to and that are being implemented with the Basel Committee on Banking Supervision and the FSB monitoring this implementation. Saudi Arabia, thus far, among the few countries that have completed the adoption of almost all the entire set of standards in terms of capital requirements, leverage ratio, liquidity, large exposure, disclosure, interest rate risk in the banking book, and requirements for systemically important banks. In other core reform areas outside the banking sector on which the G20 has agreed, we are making good progress as well. SAMA also has macroprudential instruments at its disposal for fine-tuning liquidity conditions in the economy and safeguarding financial stability. Our macroprudential toolbox has notably allowed us to maintain the financial stability in the face of changes to the flows of capital into and out of our country. As you will know, we are not using a fluctuating exchange rate as a kind of safety valve in this respect. A pegged exchange rate arrangement is the basis of our monetary framework, and it has been serving us very well. SAMA's contribution to the Vision 2030 should be seen in the context of its role in maintaining monetary and financial stability. Alongside, SAMA is contributing to a key part of the vision realization programs, namely the Financial Sector Development Program. This program has several objectives: financial diversity, financial inclusiveness, financial stability, digital transformation, and increasing the depth of the financial sector. Let me just touch on two of these elements. First, digital transformation, and second, financial diversity. The two very interesting sessions on the financial innovation and digital finance just prior to the lunch testify to the global importance of digital transformation. In Saudi Arabia, SAMA, as well as other financial authorities, are committed to supporting fintech activity in the financial services industry. I already mentioned that at the IIF meeting in Buenos Aires last year, that Saudi Arabia has a very positive attitude towards the fintech. We see substantial potential for such activity to lower the cost of financial services and to foster financial deepening as well as financial inclusion. Of course, as central bank and financial market regulator, we need to closely monitor the risks that come with such increased benefits. In this context, we are supportive of banks in Saudi Arabia using blockchain technology. SAMA has also entered into an arrangement with the Central Bank of the United Arab Emirates to test the blockchain-powered financial settlements between the two countries. Turning to the financial diversity, I just want to point to the speed with which capital market reforms have been advancing in Saudi Arabia, in the context where also the banking system continues to grow. As a result, both domestic equity market and bond market are now on the verge of being included in the global equity and bond market indices. Based on the experience of other emerging economies, I see good prospects for deeper and more liquid financial markets as a consequence, which will benefit the Saudi economy. Let me, before concluding, say a few words on Saudi Arabia and the G20. The G20 finance ministers and central bank governors met for their first time in December 1999 in the wake of the Asian financial crisis, which led to the creation of the G20. Saudi Arabia participated in this inaugural meeting as well as in all subsequent meetings. Towards the end of the first decade of the G20's existence, the global financial crisis struck. And for the first time, the G20 met in the composition of heads of state or of government. At their third summit meeting in Pittsburgh, G20 leaders designated the G20 as the premier forum for their international economic cooperation. In the following years, the G20 lived up to this new status, notably by mapping out in a collaborative manner a comprehensive framework for financial stability. As we are approaching the 20th anniversary of the G20, I have no hesitation in stating that the G20 has done a tremendous job over the last decade. Saudi Arabia is proud of its membership in this forum. This can also be judged from our continued commitment to the numerous work streams that the G20 has set up over the years, and from our stronger belief in the value of international cooperation, as we have expressed and shown on many occasions. We are supportive of the priorities that the G20 is pursuing under the Japanese presidency, and we are very pleased to be part of the G20 Troika this year, together with Japan and Argentina. We are looking forward to taking on the responsibility of the G20 presidency by the end of this year. To speak about the upcoming priorities for the G20 presidency would not be timely because we are still months away from the presidency handover. Saudi Arabia's current focus, however, is on enabling the Japanese G20 presidency to achieve its objectives. Later this month, the G20 leaders will gather in Osaka for their annual meeting, and Saudi Arabia will definitely be among those achieving successful summit outcome. The session immediately following my talk will deal with the G20 priorities and will address the question on how the private sector can best support the goals by the G20 policymakers. So this is a splendid opportunity to continue reflection on the topic of G20 priorities. To conclude, the idea behind such a session coincides with the firm belief I have in good mutual interaction between private financial sector and the authorities being a cornerstone of successful financial development. I'm practicing this in my home country, and I am heartened to see that the IIF is playing similar role at the international level. I wish you a successful continuation of your meeting today, and thank you for your attention.